What if I told you that the single biggest financial event millions of people have been waiting for, the revaluation of the Iraqi dinar, is not just a matter of economics, but a high-stakes geopolitical chess game where the final move is about to be played, and the outcome in 2025 is not what any of the so-called gurus predicted. Forget everything you've heard in those echo chambers. The real story is unfolding right now in the corridors of power in Baghdad and Washington, and it's far more complex and shocking than a simple number change. The Central Bank of Iraq has just dropped a bombshell that has sent seismic waves through the entire investment community, officially announcing a comprehensive strategic plan to liberate the Iraqi dinar from the stranglehold of the US dollar. A plan so ambitious it aims to completely reshape the nation's financial landscape by the end of this decade. This isn't just another rumor. This is a publicly declared war on dollar dominance within Iraq's own borders. And the first major battle has already begun with the launch of a massive financial engineering project aimed at mopping up the terrifyingly massive excess liquidity of trillions of dinars swimming in the local economy, which has been the primary anchor dragging down the currency's value for decades. The central bank is deploying a multi-pronged attack, aggressively issuing high-yield government bonds and treasury certificates to suck this excess cash out of the system, a move that is fundamentally designed to create artificial scarcity and increase the dinar's intrinsic value. But here comes the brutal twist that no one is talking about. While this sounds like a brilliant strategy on paper, the execution is creating a nightmare scenario of unintended consequences that is currently paralyzing the Iraqi banking sector. To comply with new, stricter international anti-money laundering standards, particularly those enforced by the U.S. Treasury, Iraqi banks have been forced to freeze the accounts of thousands of businesses and individual depositors, effectively locking away millions of dollars and creating a devastating liquidity crunch not of cash, but of usable capital. This means that while the central bank is trying to reduce the money supply, the commercial banks are simultaneously being forced to strangle the everyday economic activity that is the very lifeblood of a revaluation. The result? A surreal and contradictory reality where the official exchange rate remains stable on government charts, but the average Iraqi businessman on the street faces a parallel, brutal black market rate where the dinar is significantly weaker, creating a two-tiered economy that is tearing the country's financial fabric apart. This internal chaos is directly clashing with the other cornerstone of the revaluation plan, the desperate push towards a cashless society. The government is desperately promoting electronic payments and digital wallets to reduce the physical dinar in circulation and bring a shadow economy, estimated to be as large as 60% of the total, into the taxable light. However, this digital leap is hitting a brick wall of infrastructure and trust, with frequent power outages, limited internet access, and a deep-seated public mistrust of banks after decades of corruption and conflict. The transition is agonizingly slow. So, we are left with a breathtaking paradox. The Iraqi government and central bank are simultaneously fighting a war on three fronts: against the US dollar's dominance, against the mountain of physical dinar cash, and against a sprawling informal economy, all while their own banking system is partially frozen and their population is hesitant to adopt the digital tools needed for the plan to succeed. The ultimate, multi-million-dollar question for every investor is this: can the Central Bank of Iraq win this three-front war fast enough to trigger the long-awaited revaluation, or will the weight of these internal contradictions and external pressures cause the entire meticulously crafted strategy to collapse under its own complexity, leaving the dinar in a perpetual state of promise? The answer lies not in a boardroom, but in the chaotic streets of Baghdad and the tense meeting rooms where international compliance officers are currently deciding the fate of billions of frozen dollars. Now, let's pivot to the other side of the world and examine the Vietnamese Dong, a currency that is presenting a paradox so profound that it has left top-tier financial analysts at institutions like HSBC and the World Bank scratching their heads. Because what we are witnessing is the bizarre phenomenon of an economic powerhouse producing a currency that, on the surface, appears to be stubbornly weak. And this contradiction is where the real opportunity and danger lies for astute investors. On one hand, the macroeconomic data coming out of Vietnam is nothing short of spectacular, the kind of growth story that fund managers dream about. The economy is a roaring engine, with GDP growth skyrocketing to a stunning 8.2% in the third quarter. a figure that dramatically outpaces every other major economy in the ASEAN region and positions Vietnam as a primary beneficiary of the global supply chain realignment. Foreign direct investment is flooding in, with registered capital soaring to an estimated $18.5 billion, as giants like Samsung, Intel, and Nvidia continue to pour billions into expanding their manufacturing footprints, effectively turning the country into a new global hub for electronics and high-tech assembly. The stock market has been on a historic bull run, delivering returns that have eclipsed 57% and attracting a wave of international capital, and exports have surged past the $300 billion mark, creating a massive trade surplus that should, in any conventional economic textbook, create immense upward pressure on the currency's value. Yet, when you look at the exchange rate, the Dong tells a completely different and confounding story, trading at a record weak point of over 26,385 to the US dollar and having depreciated by nearly 4% over the past year, languishing near its all-time lows and defying the logic of its own nation's stellar economic performance. So, what is the mysterious force holding the Dong down, and why isn't this economic miracle translating into currency strength? The answer lies in a deliberate and calculated war being waged by the State Bank of Vietnam, which finds itself trapped in a policy trilemma where it can only achieve two of its three desired goals: maintaining high growth, ensuring currency stability, and keeping control of its capital flows. To fuel that explosive 8.2% GDP growth, the central bank has been forced to maintain a relatively loose monetary policy with low interest rates. But this has created a devastating interest rate differential with the United States, where the Federal Reserve has committed to a higher-for-longer policy, making it far more profitable for investors to park their money in US dollar assets, which triggers a persistent and damaging capital outflow from Vietnam. This is compounded by a second, more insidious pressure: a sudden and massive surge in domestic demand for US dollars, not for imports, but to exploit a wild arbitrage opportunity in the local gold market. The gap between the domestic price of gold and the international price has blown out to a massive 13%, creating a golden incentive for traders to acquire US dollars on the black market to buy gold abroad and sell it locally for a massive, risk-free profit. A practice that siphons billions of dollars away from the official financial system and puts intense downward pressure on the Dong. The State Bank of Vietnam's response has been a desperate and costly defense, reportedly selling a staggering $4.4 billion from its foreign exchange reserves in the first half of the year alone to prop up the Dong, an intervention that has caused its reserves to decline to a precarious $81 billion. A level that only covers about 2.3 months of imports, and is alarmingly low by international standards. This is the ultimate twist in the Dong saga. The very strength of the Vietnamese economy is forcing the central bank to burn through its financial firepower to maintain stability, creating a fragile equilibrium where any external shock, like a further spike in US interest rates or a sudden slowdown in global trade, could force a painful devaluation. The million-dollar question for every investor is whether the nation's fundamental economic strengths will eventually overcome these brutal cyclical pressures, leading to a dramatic revaluation, or if the central bank's defenses will eventually be overwhelmed, making the current weakness a permanent feature rather than a temporary anomaly. So, what does this high-stakes tug-of-war between the Iraqi dinar and the Vietnamese dong mean for you, the global investor, watching this unfold in real time in 2025? The truth is, these two currencies, though separated by thousands of miles, are now inextricably linked by the gravitational pull of a single, dominant force, the relentless strength of the US dollar, which is currently performing at its highest level in over a year, forcing millions of investors to recalibrate their entire forex strategy. We are no longer just analyzing individual national economies. We are decoding a global financial ecosystem where the policies of the US Federal Reserve, now in a cautious rate-cutting cycle, create ripple effects that can either drown emerging market currencies or carry them to new heights. When the Fed moves, the world trembles, and right now, its policy, combined with a new wave of US trade tariffs that have pushed the effective US tariff rate to a decade's high of 19.5%, is creating a perfect storm of volatility and opportunity. This is the grand chessboard, and your investment is a key piece in play. For the Iraqi dinar, the path to a genuine, sustainable revaluation is now a brutal race against time, a race to stabilize its internal banking sector, defeat the black market premium, and successfully execute its digital transformation before the next major shift in global dollar liquidity, all while navigating the immense political risk of policy stalemates in Europe, which is Iraq's crucial economic partner, and the ever-present threat of escalating trade wars that could crush global oil demand, the nation's primary lifeline. For the Vietnamese Dong, the dilemma is even more immediate. The central bank is burning through its foreign reserves, which have fallen to a precarious $81 billion, to defend the currency, a strategy that is simply unsustainable in the long term. Forcing a painful choice between abandoning its defense and risking a disorderly devaluation or further tightening monetary policy, and potentially choking the very economic growth that makes the dong so attractive to long-term investors. This is the moment of truth, and the entire forex market is holding its breath for the outcome. The convergence we are witnessing is historic. It's a clash between national economic sovereignty and the iron will of global capital flows, and your financial future is caught in the middle. This is why millions are watching right now, because the decision you make in the next few days, whether to hold, to buy the dip with extreme caution, or to diversify into other asset classes like gold, which has surged in 2025 as a hedge against this very uncertainty, could define your financial freedom for the next decade. We are at a critical inflection point, a financial nexus where the dreams of massive returns from a currency revaluation collide with the hard, unyielding realities of macroeconomics and geopolitics. The data does not lie. The charts are screaming the warning signs, and the analysts from the world's largest institutions are all pointing to the same set of explosive variables. The question is no longer if a change is coming, but when and with what magnitude, and more importantly, whether you will be positioned correctly when the dam finally breaks. The narrative that these currencies operate in a vacuum has been shattered. Their fates are now tied to the US-China trade tensions, the outcome of European elections, and the next speech from the Federal Reserve Chair. To ignore this interconnected web is to invest with blindfold, and in the high-stakes environment of 2025, that is a sure path to significant losses. The opportunity is still here, it is still real, but it is now more complex and more dangerous than ever before, requiring a level of insight and strategic patience that goes far beyond mere hope. This is the final update before the landscape changes forever.